What is the definition of stranded costs? Have you ever wondered how changes in the energy market can impact utility companies? One term that comes up often in this context is stranded costs. So, what exactly does that mean? Stranded costs refer to the financial burden that utility companies face when their investments in infrastructure lose value. This usually happens when market conditions shift or when regulations change. In the world of energy deregulation, this is particularly relevant. When industries like electricity transition from being regulated monopolies to competitive markets, utilities that have invested heavily may find it hard to recover those costs. Imagine a utility that built a power plant under the assumption that it would operate in a stable market. Once deregulation occurs, that plant may not be able to compete with newer, more efficient technologies. From a free market economic standpoint, stranded costs highlight the difficulties of moving from a regulated environment to a competitive one. In a regulated market, utilities can pass on their investment costs to consumers through higher rates. However, when competition enters the scene, these companies must compete with newer players that do not carry the same legacy costs. This can lead to challenges in maintaining profitability. In the context of energy deregulation, stranded costs can arise from investments made in power plants or transmission lines. These investments were often made with the expectation of stable returns in a regulated setting. Once deregulation takes place, the value of these assets may decrease if they cannot compete effectively. This financial strain can impact a utility's ability to provide services at competitive prices. Republicans often advocate for deregulation as a way to stimulate economic growth. They believe that increasing competition can lead to lower prices and better services for consumers. However, they also recognize the challenges posed by stranded costs. To address this issue, some propose solutions like phased deregulation or temporary financial support for utilities. These strategies aim to help utilities adjust to the new market conditions while still encouraging competition and innovation in the energy sector. Understanding stranded costs is essential for grasping the complexities of energy deregulation and its effects on the economy. By recognizing how these costs impact utility companies, we can better appreciate the balance between competition and the financial realities that come with transitioning to a free market.